Fixed income is one of the most traditional and secure forms of investment. Unlike variable income, where returns are uncertain and can vary significantly, fixed income offers predictability and security to the investor. In this type of investment, conditions such as term and interest rate are established at the time of application, allowing the investor to know exactly what to expect at the end of the period. Fixed income refers to any type of investment where the return is defined at the time of application. This includes products such as certificates of deposit, CDs, treasury securities, municipal bonds, and corporate bonds. Essentially, fixed income is a loan that the investor makes to a financial institution, company, or government, which promises to repay the principal amount invested along with interest. Fixed income refers to any type of investment where the return is defined at the time of application. This includes products such as certificates of deposit, CDs, treasury securities, municipal bonds, and corporate bonds. Essentially, fixed income is a loan that the investor makes to a financial institution, company, or government, which promises to repay the principal amount invested along with interest. Advantages of CDs. Security. CDs are covered by the Federal Deposit Insurance Corporation, FDIC, up to the limit of $250,000 per depositor, providing additional security. Variety of options. There are CDs with different terms and interest rates, allowing the investor to choose the one that best suits their needs. Liquidity. Some CDs offer daily liquidity, allowing early withdrawal. How to invest in CDs. Choose a financial institution. This can be your bank or an online brokerage. Evaluate available options. Compare terms, interest rates, and liquidity. Make the application through online banking, brokerage app, or directly at the branch. Practical example. Imagine you invest $10,000 in a CD with a rate of 2% per year for a period of 2 years. At the end of the period, you will have approximately $10,404 after deducting any applicable taxes. What are Treasury securities? Treasury securities are issued by the U.S. government to finance its activities. There are various types of Treasury securities, including Treasury bills, T-bills, Treasury notes, T-notes, and Treasury bonds, T-bonds. Advantages of Treasury securities. Security. Considered the safest investments in the market, as they are guaranteed by the government. Variety of options. Allow different investment strategies with various terms and indexes. Ease of access. Can be easily purchased through the Treasury Direct website. How to invest in Treasury securities. Open an account on Treasury Direct. Necessary to access Treasury securities. Choose the appropriate security based on your objectives and investor profile. Make the application through the Treasury Direct platform. Make the application through the Treasury Direct platform. What are municipal bonds? Municipal bonds are issued by state and local governments to finance public projects. They often offer tax-exempt interest income. Advantages of municipal bonds. Tax exemption. Interest earned is often exempt from federal income tax and possibly state and local taxes. Security. Generally considered safe, depending on the issuing municipality's financial health. Support local projects. Investing in municipal bonds helps fund community projects. How to invest in municipal bonds. Choose a brokerage necessary to access the municipal bond market. Analyze available bonds. Evaluate the issuing municipality, interest rates, and terms. Make the application through the brokerage's platform. Practical example. Investing $20,000 in a municipal bond with a 3% annual yield for 5 years, you would earn approximately $3,000 in interest, which may be exempt from federal taxes. What are corporate bonds? Corporate bonds are debt securities issued by companies to raise capital. They generally offer higher yields than government or municipal bonds, but come with higher risk. Advantages of corporate bonds: higher potential returns, usually offer higher interest rates compared to other fixed income products. Diversification allows for diversifying your investment portfolio. Potential tax benefits: some corporate bonds may offer favorable tax treatment. How to invest in corporate bonds: choose a brokerage necessary to access the corporate bond market. Evaluate available bonds. Consider the company's credit rating, interest rate, and term. Make the application through the brokerage's platform. Practical example: if you invest $10,000 in a corporate bond with a 4% annual yield for 3 years, you will earn approximately bem to $248 in interest after accounting for taxes, if applicable. Comparing different fixed income investment security: most secure, Treasury securities; A-secure, CDs, covered by FDIC; municipal bonds, depending on the issuer's financial health; less secure, corporate bonds, depend on the issuing company's financial health; return potential, highest potential returns, corporate bonds; moderate returns, CDs, municipal bonds; lower returns, Treasury securities. Illiquidity high. Liquidity: Treasury securities, especially T-bills; some CDs with daily liquidity. Moderate liquidity, municipal bonds. Lower liquidity, corporate bonds, may have less liquidity in the secondary market. Useful tips for fixed income investors: diversify. Do not put all your capital in a single type of investment. Diversify among CDs, Treasury securities, municipal bonds, and corporate bonds. Consider investment term. Align the term of your investments with your financial goals. Evaluate interest rates. Compare offered rates and consider the economic scenario to predict if the rates are attractive. Check liquidity. Assess if you might need the money before the investment matures. Monitor the market. Stay alert to changes in interest rates and the economy that may affect your investments. Consider taxation. Remember the impact of taxes on your returns and choose tax-exempt products when possible. Investing in fixed income is a smart strategy for those seeking security and predictability. Products such as CDs, Treasury securities, municipal bonds, and corporate bonds offer a range of options for different profiles and financial goals. By understanding the characteristics of each product and following useful tips, you can build a diversified portfolio aligned with your financial goals, maximizing the benefits of fixed income.